Hello and welcome to another edition of Nucleus Investment Insights. This week we are having a deep dive into the metals mania. So we've got metals prices going nuts across a whole bunch of different versions. So it sort of started in copper, but it's spreading outwards. And so we thought grabbing Dave to run through that would be a good plan. Just a reminder, everything you hear today is general advice in nature and it's not personal financial advice. If you do want personal financial advice, you can give us a call. Either book in or give us a call, and we can work out what to do for your situation. With that aside, we will jump straight into it. Welcome aboard, Dave.
G'day, Damo, and thanks for anyone tuning in.
Yes. So yeah. Oh, sorry.
I've got a nasty case of deja vu here today, basically, because it seems every 18 months or 2 years we rerun this podcast where for one reason or another markets have gone crazy about metals again, and it never seems to have much longevity or credibility, but we're going to take a look at it and see if there's something different this time. So I mean, I've called it this time it's different again. It just looks very reminiscent of some of the stuff that we were all talking about 18 months ago. So what are the arguments right now behind the metal surge to see if things have changed from a few years ago? Well, as Davo said, we're seeing base metals go really crazy, and they were joined by bulk commodities as well. Sort of a month or so ago. And as Damo says, this has been emanating very strongly from copper. Now that trade is very energy intensive driven. Of course it is, given it's copper and it's so integral to a couple of energy stories. The first one being the great decarbonisation and transition. Second one that probably has really kind of kicked off the huge surge we've seen in the last couple of months is AI and energy. The notion that the AI revolution and data centers in particular will actually lift energy demand while reducing labor demand, which is a curious combination. Again, that comes back to copper. The markets sort of all this year have embraced, the soft landing view of the global recovery. And so that's kind of the backdrop that's giving metals a little bit of a bid. And the final factor is suddenly, according to a number of analysts, Chinese housing is kind of, at the bottom and going to bounce imminently as an historic rescue hits the market that was released about 3 weeks ago, reduced down payments, slashing interest rates, and all the usual kind of monetary stuff that we see when a housing market is falling apart. So all of those factors.
And the other one as well was the BHP takeover for Anglo, yes. Just sort of like a bit of a bit of focus again,
So it did, yes. Sector. Yeah, I mean, there's always that melt up sort of frenzy, isn't there? So Anglo's not a bad place to start because, of course, that merger has failed today, that takeover, and so I think that's more or less what I think about this in general, this overall bounce. But there's one other factor, of course, which is Fed cuts, which the market is hoping for as we see this disinflationary soft landing, rotate through its paces, and I'm on board with that, really, more or less. And so, I mean, it's not a terrible argument. The question is it a good argument? And how much longevity is there to it? And is it really something that would drive you into a highly cyclical commodity bet, as it were?
And so can I do the I've just finished a big post on NVIDIA that's up on our site and the Macro Business site as well, and Livewire or a few other places. But I just sort of thought, given I've done a little bit of work into that, I just want to highlight this idea that copper is the AI metal. If you want to play on AI, you want some copper. And it sort of comes back to something I was looking at somebody's post the other day talking about, 4 times the copper demand going to be needed for data centers and transmission and all this stuff like that. And you look and, by 2050, they've got to, you've got to increase by 300% the amount of copper. And you're like, yeah, but that doesn't tell you how big the copper market is as a total. Like when you work that through and you go, okay, well, that actually sort of means there's about 3 million tons used in, this is both electricity and in data centers, is you go, okay, there's 3 million tons used a year. You need to increase that to 12 million tons, right? You need 9 million tons per annum extra. Well, the whole market's 30 million tons. And this is by 2050. So if you do the maths, basically you need a 1% per annum increase in the metals to meet all that demand. And so it's really just not that big. Like you hear these big numbers come up, but it's really just not that big. That's the first part. The second part is one of the slides, I actually should have brought it up in this one, is NVIDIA is looking at ways they can process the data a lot more efficiently. And so you're dealing with these massive data sets, and it actually costs a fair bit of money to ship that data around if you're sending it across data centers and between data centers. And so a lot of the focus NVIDIA's been on is looking at looking at how they can bring that data closer to the GPUs, the things that are actually doing the calculations. And some of that's by stacking this memory and getting it integrating the memory really closely with the calculations. And some of it's actually just getting these getting the chips to talk to each other on a relatively close basis, within a meter or two of each other. And so and both of those decrease the amount of electricity used by factors of like hundreds. The first one sort of factor of in the tens, and the second one's in the factor of hundreds. And so there's this idea that yes, this stuff is expensive, and at the moment you look at how that is passing around. But if you think about it from the guys who are actually making the chips, they look upon this as saying, a data center cares about what the cost is to do the production. And so if they're looking at it going, there's 10 cents to do this some production, and 5 cents of that's electricity, and 5 cents of that is all this other data equipment, then if the person who produces the chips can reduce the cost of electricity, then they can increase their margin. They can, the data center is prepared to pay 10 cents. If I can come out with something where they save, they cut their energy bill by by 90%, which is what most of these are going to do, much more than that, 99%, some of them. And so, okay, and all of a sudden there's 5 cents saved or 4 and a bit cents saved on the data production. Now I can increase my margin. And so they're highly incentivized to try and bring back the electricity use. So it's, I guess the net effect is, yes, it's energy intensive, but just the numbers just aren't that big overall. And secondly, they're doing everything they can to bring it down. It's more of a factor of the way things have moved rather than something special about that. Sorry, Dave, back over to you for actually on the green metals, that fits the same way. So the green metals are the same, and the biggest one, done a few posts on this over the time, but the biggest one on the electric vehicles is that you'll see a few things out there on about the amount of copper that goes into electric vehicles and how it's 4 times bigger than a normal vehicle. And that could be true. Like you can certainly find a car where that is true. It's probably more like 2 to 2.5 times for most cars. So it's still significant. But the big issue you got to factor in is the whole driverless cars. And so if you think driverless cars are coming, then there's going to be way less cars actually built. What we'll find is that each driverless car will get rid of 4 or 5 seldom used cars, while in terms of taxi services and things like that. So it's sort of it's a bit of a two-edged sword, that whole green bit. It could actually decimate decimate the use of copper in cars. But again, it's just not that big as a total market. So if you sort of went, if you did move to that, and then again you might say, okay, well, maybe so you got 1% extra per annum. You're going to need to increase copper to get rid of all your extra data center and all your extra transmission and electricity needs. That's sort of right across the board. You might need another 1% per annum if you thought everyone was going to go to electric cars and driverless cars wouldn't work. So again, it's meaningful, it's great, it's nice to have, but it's just not game changing for that whole sector.
And I would add to Damo's raining on the copper parade by pointing out that I don't think Chinese housing has bottomed either. And there's a great deal of copper in Chinese building, and I haven't got the specific figures for you here on copper. We'll look at some of the metals further on in this post, but China's consumption was falling the last time I looked at it this year, copper consumption, and that's because so much of it goes into apartment construction, and it just doesn't look to me like we're at the end of that adjustment. The rescue as such is more aggressive than we've seen previously, but the pain in the property market in China is much more intense than we've seen as well. And so if you adjust for where we are in the cycle, I think it's another attempt to slow the adjustment rather than ending it. It seems to me Beijing long ago determined that it was going to ride this one out, and it still is. And that if we do see any rebound in property, it will take a long time before it delivers any boost to construction. And therefore, you have a pipeline of sales that will continue to drag down the floor area under construction, the stock of floor area under construction, which should determine construction demand for copper in China. And that's got another, even if we get a bit of a cyclical bounce, that's got another 18 months, 2 years to run before we get any kind of construction upside out of China. So it's just, I've been reading all sorts of throwaway. Sorry,
but saying in terms of upside as well is that's taking a pretty optimistic view about.
Well, it is
even still, isn't it?
Exactly right.
If you look at a shrinking population,
on most cases it keeps going down. So,
yeah, shrinking population, all that type of stuff.
Yeah, that's right. As we know, we've discussed many times, the 5 Ds: deglobalization, debt, demographics, deflation, and dictator are still combined and still winning out. Sort of 3 weeks into this bazooka, as it were. Now, don't get me wrong. I'm sure we'll see some traction, some green shoots here and there, but I just don't think it's a game changer yet. And I don't think they want to change the game. And more crucially, they're just trying to manage it so that they don't kill their banking system, and they're sort of pushing the bailout around the economy in a way that they think is most constructive, without it being seen as a bailout, more or less. So I think it probably continues to get worse, but even if it doesn't, the bottom line is there's more falls in construction baked in throughout 2025, and so I'm not enthusiastic about copper demand in China, and this is just reminiscent of 2 years ago when everyone was screaming it was a new super cycle for metals and what have you, and it's
exactly the same arguments
going bust until here we are. I mean, and even things like nickel, which is a kind of not really a green metal, but and exposed to steel and stuff that's really in trouble. And a month ago or 6 weeks ago was a disaster. With mines closing and what have you. And of course, that's the way the commodity cycle goes. But, nickel's now off to the races as well. And all of the metals are kind of chasing copper. So it just looks like a return to, the race course. But anyway.
But it's a good parallel, though, is that, it was a very much a stockbroker-driven event last time around. There's all this idea and this hype, and you got to save yourself from inflation by buying commodities. And I'm sure we'll talk about that a bit later. But there's the there was the
Look,
whole
you can actually
Russia.
pinpoint the big movements in copper to Goldman research reports, right? Like I've been reading them all the way through, just waiting for it to take off, watching them prime it. And I'm sure they're in the background, and they all make the same argument, right? Low inventories is the key to the argument, implying supply side constraint, basically. And the thing is, though, those inventory numbers just can't be trusted. Like they come out of bonded warehouses and in Shanghai and London Metals Exchange, and there's all sorts of chicanery that goes on behind those numbers with pallets of millions of tons of metal moving around, from one side of a warehouse to the other, and and it's not just the investment banks; it's the big commodity traders that are in the game. And I mean, even Trafigura, I think this week they'd managed to corner something or other. I can't remember what it was. Maybe tin. I can't remember. They'd cornered some metal and they were drip feeding it into Wall Street banks. And like this is the way this game is played. And so it just looks like kind of financialization rather than anything super cycle. But at the same time, if you've got circumstances in which Wall Street and others can do this and make these arguments and push money around, then you have to ask yourself, does it become a reflexive trade that is self-fulfilling? And at this point, well, the problem is they're not supply constrained. So if you push the price up, then miners start digging.
Yeah, and that's right, and that's why I keep coming back to this whole thing. Like every cycle doesn't have to be super. Like this is, and there's it can just be a cycle. And there's to me there's an inventory cycle, which is the whole we've got too much demand or supply imbalance or whatever like that. But then there's the actual whole longer term construction cycles, and that's and that's the part where it just doesn't look like that's changing at all. This just looks like a short-term inventory cycle, and as you said, maybe it's manipulated, maybe it's not. Who knows what it is? But at least it's when you look at the actual volumes of copper, like if you go back to the 2000s and you look at the massive increases we saw in just the amount that was being done, you sort of doubled over a 5-10 year period in terms of the amount of copper that was actually being used. Like that's a super cycle.
Yeah.
Talking about going, this year we might be up a few percent in terms of and stuff like that.
10 or 20% a year. Not one. Yeah.
Yes.
That does give you, a supply shock. So, you do need high prices to incentivize the miners to dig. But in the short term, the markets can push this stuff around. So I just thought I'd quickly revisit, the kind of superstar of the last time this happened, just to see if that was, kind of still playing out in any way. And some viewers may recall Zoltan Poszar of Credit Suisse, who, was a monetary economist who made himself suddenly very famous a couple of years ago when he declared Bretton Woods 3 was underway, which was, to cut up a very long story short, basically was that he was arguing commodities were like the new reserve currency of the world.
And this was a China / Russia, or more probably Russia / China, dissociating from the rest of the world, and this is what this was going to be their new currency because they were locked out of the US dollar and all these other things like that.
That's right. Now, since then, both Zoltan and Credit Suisse are gone. Not together. I think Zoltan quit and started his own Bretton Woods fund, or Bretton Woods 3 fund. That was the last he's been heard of. So I wish him well. I hope he's going all right. I hope he wasn't long commodities over the last few years, but anyway, the Bretton Woods 3 thesis is not throwaway stuff. It was very well thought through, and I would lay it up against my own sort of thesis about Cold War 2.0, where geopolitics is sort of overtaking markets steadily but surely, and so access to real assets like commodities will develop a bit of a premium in that scenario, both for security of supply for the state if it sees itself threatened in a kinetic war scenario, or in terms of monetary security. So as Damo mentioned with the Russo-Sino kind of alliance and the invasion of Ukraine, we saw the freezing of Russian assets and treasuries and what have you in the US, and the booting of Russia from the SWIFT system, of bank exchange. And so, there is evidence to suggest that very serious money, like sovereign money, is awake to that risk and is playing a role in some metals markets at the moment. And the one in particular I'm talking about is gold, which makes sort of more sense than your average industrial commodity, because it is more genuinely supply constrained because it's stockpiled and used as a currency, basically. So
but that's the nasty thing, isn't it, with copper and all those ones, is you go and corner the market, or you go and buy a whole bunch of it, and then all of a sudden some miner somewhere is incentivized to open a new mine because you've put the price up.
Exactly.
And all of a sudden this extra supply comes up. Whereas in gold, there's so much gold out there.
Miners can do that with gold as well, of course. But
but there's so much gold out there that one new mine in gold just doesn't make a difference.
Yeah, and copper mines are very big, as we know. So, gold kind of cuts the mustard on that argument, but I'm not sure that the industrial metals complex does. It certainly would if we were to see increasing tensions, superpower tensions in particular, for example, around Taiwan, then, there'd be kind of
two-edged
swings and roundabouts in that scenario. You would certainly see China wanting to stockpile metals, and that may trigger everybody stockpiling them. Yeah. But at the same time, any scenario in which China is struggling to get a hold of metals is pretty bad for metals.
Yeah, exactly. Your average Australian miner who's just dug stuff up and wants to send a ship to China and is being told, no, you're not allowed to anymore.
That's exactly right. So
where are we going to send it then?
Yeah, that's right.
We're going to dump it on the rest of the market and crash the price.
And so that's got its ins and outs, that argument. Look, it's probably, based on, say, if we took the analog of the Ukraine war as one for Taiwan, then, probably would at least be bullish for commodities in just short-term panic.
Yes.
But
that's what I was going to say.
Would it protect you through the entire shock? Well,
I'd say absolutely not. I'd just say, your idea is if you're adamant that's going to happen, is maybe you might want to jump in and buy metals, but you want to be selling them as everyone starts telling you, as all this.
Well, kind of, yeah. And you'd want to be very careful about which metal. Like you wouldn't want to be buying things like iron ore, I wouldn't think, but gold would be very useful in that scenario. I'm not sure any industrial metal is something I'd want to be holding in that conflict, but nor the softs for that matter. You'd be knocking out an enormous demand out of the global economy if you end up blockading China by sea. And that's a lot of stuff that just will have nowhere to go. We find the Bretton Woods 3 argument interesting, but not ultimately persuasive, except in very particular channels. So I'm talking about commodities, obviously, and gold is one of those channels, I think. And that's where we're seeing the impact, I think, as well, in terms of central bank buying. And that comes back to the particular nature of gold, where it has a role as currency as well as a metal, whereas other metals are just, dirt transformed. So the other sort of argument currently being used is you need commodities as an inflation hedge, and so you you need to, the sexy portfolio of the day is, instead of 60-40 all-weather portfolio, the new all-weather portfolio is 25-25-25, which is 25 stocks, bonds, commodities, and gold, is it? I can't remember. What's the last 25?
Yeah, it might be gold. I'm not. Yeah,
I can't even remember. I'm sorry, but so this is putting commodities at the absolute centre of your portfolio as an all-weather feature, and based on this idea that commodities are an inflation hedge, but I mean, are they? And there are certainly times when they are, when, like, for instance, there's a war and there is supply constraint, such as there was when Russia invaded Ukraine, and various boycotts knocked Russian supply out of things like gas and oil and other things. But I mean, typically, commodities, as we've discussed, are not supply constrained at all.
Well, and the interesting thing with this chart you've got up there is exactly what I push, is that over the long term, most commodities, the real price of the commodities is pretty consistent, which is basically mean the price is going backwards in
exactly.
Yeah, so you're going up. You might be going up slower than what inflation is, and you look at this chart we've got up there at the moment. For anyone who's listening in, this is sort of comparing the raw industrial metals to the global median CPI, and they look like they're a relatively nice match. But then when you look at the axes, it's like, well, just a minute, it's a nice match, because for large parts of it, when inflation's sort of 2 or 3%, metals are negative. So you're basically saying your axes don't fit. So you're sort of looking at it and going, well, even when I'm plenty of places where you're looking at 3% inflation and negative metals price growth. So
yes, exactly. So it's not a one size fits all answer is the lesson or the takeout. You can't just buy any old commodity and think you're going to be protected, because as Damo said, they basically fall in real terms over the long term. Now, you might be a Malthusian and think we've reached a tipping point, like Jeremy Grantham, where we're just running out of everything. But we're just not of that ilk. I mean,
and sorry, just to explain the Malthusian, that's basically saying we've only got there's a finite amount of all these resources. We're getting close to the end, and so at some stage, prices are going to go ballistic because we just haven't got enough of this stuff.
Yeah.
And particularly in copper, that's one I've debunked several times, where people are like talking about saying, well, the copper grades used to be 10%, and now they're like, close to, they're 0.3 and 0.4 or whatever. Is actually saying, well, yeah, but we used to use a shovel and a pickaxe to get it. The technology's changed, and when you look at the real prices, in over long periods of time, the copper price really just hasn't moved, and it's falling because it's always falling. Yeah.
No, exactly. So again, I think gold is probably an exception, although not necessarily even gold. Not strictly speaking, gold and inflation. Like, I actually largely see gold as a deflationary metal for the most part. But I think if you put it in the circumstances of inflation and conflict, geopolitical problems, demand for safe havens, that's the kind of environment in which gold could really protect you from inflation, and that's precisely what may come if we get great power conflict around Taiwan, for instance. I mean, there might be others, of course, but that's obviously the one that's on everyone's minds over the next kind of 10 to 15 years.
But before we get into some of the other metals, we might just go to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So lithium, David.
Oh, well, I just want to point one more thing out about an inflation hedging and what have you. I mean, we do get these amazing moments in commodities where you do have Wall Street going nuts and pump priming certain metals. And there is a sense at those moments where you do have a reflexive trade. So you've got to buy metals because you've got inflation, and you've got inflation because everyone's buying metals. And there is something in that at certain moments, but that's what this chart again tells you. You know, that's what happened in COVID, where you had genuine supply constraints and everyone going nuts over it with massive liquidity looking for a home and what have you. And so you got this great correlation, as we've got in this chart, between the CPI and commodities. So that trade certainly worked very well in COVID, but I don't think it can be relied upon as an inflation hedge, generally speaking. Specific commodities. Well, we've already pretty much covered copper, and Damo's given that its wrap. Other base metals. I mean, we're not particularly focused on metals, but they all have the same basic dynamics. That is, that they're common and largely cheap, even if they weren't as cheap as they used to be, and they will be dug up if you set a price to do that. And so you're always looking at a kind of 18-month, 2-year trade that will have a deluge of supply coming at you, because they can't drip feed supply in commodities. They're always bulk mined and.
Not all. I think that's probably where gold is one of those opposite examples. Yeah, but yes. You're right in that the
base metals though.
Yeah, and that's definitely getting worse in terms of the worse. Sorry, when I say worse, it's like we spoke a little bit about copper, saying the way they're doing it now tends to be a lot more sort of bulk mining than artisanal mining, and so. And the techniques are more about going, okay, we've just got to get economies of scale when you do these things. And that's lithium, very much so.
Yes, it is. Although, I mean, we still see potential for that to repeat, right?
Oh, absolutely. And the big difference, lithium is a super cycle. Lithium's definitely a super cycle.
Exactly.
And the reason why...
It's glutted now for a couple of years, but...
Well... I don't even know if a couple of years. Oh, sorry. When I say I don't know about a couple of years, the problem for me with lithium is it is growing so quickly that you just can't forecast it, because it's along the lines of going, okay, it's growing at 25, 30% per annum in terms of the supply and the demand. And so if supply grows at 35 and demand grows at 32, then all of a sudden the market's flooded and prices crash. If it's the other way around, supply grows at 35 and demand's at 32, then the other way, demand, then all of a sudden the price booms. And that's the problem, very much for lithium is getting that idea that, that $10,000 level for me is about saying, okay, well, anywhere near $10,000, that's when mines do genuinely start to close down. So, that's an interesting place to be buying. But when you're talking about $50,000 and $100,000, like they're making, there's barely lithium mines anywhere that don't make money at those prices. And if you get high enough, it's almost worth pulling it from seawater at some of those. So at that point, it's not not unlimited, but it's not far off. So you got to sort of temper where the prices are genuinely going to be in terms of.
And those are the same dynamics, of course.
Yeah, and just recognize that if you're getting those prices, great. Getting $100,000 a ton for it, fantastic. Take it, and factor that in. But don't, if you're doing a bit of modeling, don't put that any more than a year or 2 years into your model, because it's could just we'll see exactly what we've seen over the last. We've already seen 2 big lithium cycles just in the last 10 years, where price shoots up, drops down, price shoots up, drops down, and here we go. We're up to number 3 in just in the last decade, and that is a genuine super cycle, though, because the growth is so big in that commodity. Yeah.
Yes. So So gold, like I've had an interesting relationship with gold this year. I mean, I actually abandoned it a few months ago just as it took off, on the argument that it had dislocated from its traditional fundamentals. So real interest rates were rising and the US dollar was rising, and yet gold was going up. And I'm like, well, that doesn't make sense. And so, I just said, I put it down to cryptocurrency. In fact, like I just said, I think there's some weird price distortion going on in gold because it's chasing Bitcoin. What was actually happening is that, gold was functioning more as a safe haven, amid this weaponization of treasuries for central banks, I think. And very big Chinese demand on the back of that notion. And so, in a longer term sense, gold versus Cold War 2.0, I think is a reasonable argument for investment, that gold could go higher. So, it's pretty handy having central banks buying your commodity and stockpiling it for you. So, if they get really nervous about where they were putting their money and putting in gold, even a small move into gold is very big because it's quite a small market, relatively speaking. So,
and the other thing is, when central banks start buying, then investors also go trying to front run all the central banks, and so
they do. Yes,
it's a rush in and a rush out,
which we've been seeing as well. So, I mean, I think gold is it's entering a bit of a correction at the moment. It's probably could run for a quarter or so. I don't know how far, but I'm pretty constructive on the US dollar. I think real interest rates will probably roll over in the second half as well, and so real interest rates will probably rise towards the US election, and so gold's probably going to keep correcting for a bit. But buying that dip's probably not a bad play for a longer term anchor for your portfolio. And then there's the bulk commodities. Your coals and your iron ore, etc., which I just wouldn't touch with a barge pole. None of them, unless you're short, because I think Chinese property just has more room to fall, more construction to shed, and that's really a secular story for us. Yes, there'll be ebbs and flows within it, but we're just getting started there, and we think 2025 is particularly troubled. There's plenty of inventory for all three commodities. They're all driven by China. They're all heavily. There's huge stockpiles of all three in China at the moment. The inventory cycle is quite full, and it's not a great outlook, basically, for demand. Terrible.
Let's just jump to a sales message, and then we'll come back with the investment views.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, and so how does that sort of outlook for commodities sort of color the way you're looking at sort of asset allocation and what else you're doing in sort of stock markets and types of stocks you're buying?
Well, I'm not particularly enthusiastic about metals. I mean, gold, I've kind of gone completely around the carousel, as it were. Having abandoned it a few months ago, I can see there probably is an argument for gold. But beyond that, the idea of buying 25% of the portfolio as an all-weather play, I just think you're sitting on a boom bust asset that has no return, like doesn't offer you any interest rate or return, and so you're really parking a huge slab of your portfolio in a giant nothing burger that may or may not protect you from inflation. So I'm not big on restructuring portfolios with this huge allocation to commodities.
I mean, if you're a trader, I can see an argument. If you're a trader and you're like, "Hey,
sure,
everyone's trying to blow the bubble. I can jump
Oh,
into
absolutely,
this, and it could easily go higher, and then I'll trade myself
mate,
out."
if you got access to Goldman research, then
early access and research. You don't want to be the last on that.
The moment they put out a copper note, then go buy copper.
Yeah,
but I mean, we're talking all weather portfolios for punters.
Yeah,
doesn't
as a longer term. Yeah, that's right. So there's a good example. 2 years ago, you could have bought that entire argument, and as all these prices boomed, and right now you're probably just getting back to even or whatever from because you still be down. You fell down. Yeah, you fell whatever it was, 15-20% at least over that period.
Yeah, and it's just a huge slab of your portfolio that's immensely volatile. I mean, that's the thing. Commodities are hugely volatile.
Yeah.
They really are a boom bust asset. So,
which is why stockbrokers love them. You can talk about the peak of the cycle, you get everyone to buy in, and then you get them to sell out.
Talk up commodities. So in asset allocation terms, they don't make a lot of sense for the long term. I don't think. That said, I'd be looking at commodities as bifurcation play, I guess, for want of a better word, or variability, whatever word you want to choose. And I'd be very specific about what I played in. As said, we think lithium's in a genuine super cycle. So if you think you've got, a decent handle on when lithium's going to run short, then and it take off again, then go for your life. I think gold's the real winner out of most of these arguments. So there's something in there, and if you're on the short side, then there's lots of opportunities in the bulks and potentially playing the downside of these arguments coming out of Wall Street at the moment. If you were short metals over the last 2 years, then you creamed it. If you'd shorted Zoltan Poszar, you would have kicked ass. So, I don't see the commodities changing in all weather portfolio at this stage. I mean that's
we might leave it at that.
Conclusion. Sorry.
Yeah, we might leave it at that. I think there's just want to highlight that you can get Nucleus information from a whole bunch of different social media. In terms of the podcasts, we're on Google Podcasts, Apple Podcasts, Spotify. Actually, I think Google Podcasts is about to finish up. Actually, and I think it's already finished in the US. But then you can we're live on YouTube every week at 12:30 on Thursdays. And if you want any more content, nucleuswealth.com/content. If you've got any thoughts for topics, certainly drop a message for us on one of those social media, and we'll have a look. And we certainly value suggestions from people about things we can do. With all that, thanks everyone for tuning in, and we'll see everyone next week.